Hi, I'm Keith McCullough. Welcome back. Today I want to talk about gold. A lot of people talking about gold. We're getting a lot of questions about gold because, of course, we've been bearish on gold for about a year now. We are starting to tiptoe into the long side of gold. So I want to, number one, contextualize why we were bearish, and B, start to talk about how we could get bullish. But there's going to be 5 different slides that I want to go through on that. Hedgeye playbook, we will address 3 big things, which are, of course, the history of it all, the math, and then finally the behavioral aspect of trading anything, which includes gold. So the first chart that I want to look at is a history chart. So again, it provides you some context, which unanimously decides, by the way, that gold is absolutely sensitive to monetary policy. Now, Ben Bernanke would disagree with that. Janet Yellen would disagree with that. And anyone who's paying attention with a pulse and 2 ears and their eyes open could see in this chart that it's absolutely sensitive to monetary policy. So what we show here is the correlation between, number one, the US dollar and interest rates, which is the black line going down since really 1978, but more specifically in the last 12 years, and then the gray line, which is going up, which is in fact the price of gold. So again, very big correlation. We call this an inverse correlation. So when the dollar and interest rates are going down, gold goes up, and vice versa happens on the trading side of it currently. Next chart I want to look at, again, is the math. So again, the math, really important to debunking these really kind of super secret storytelling lines of the Federal Reserve. So again, the math says, look, the Fed's balance sheet equals gold. So you could see that between 2008 and 2012, which is the big green monster there, shows an R squared, or a correlation, in other words, a monkey could do it, of 0.89. A monkey could do it. Like 0.89, that's a really, really high correlation. So in other words, if the Fed balance sheet is expanding, the value of the dollar is going down, interest rates are going down, that's what they want, and the price of gold is going up. Now this runs into a problem, a nonlinear problem, when expectations change about what? Growth. Because growth does what? Growth drives interest rates, or expectations of interest rates, rising higher. So that's why gold has effectively lost its correlation, lost its way, lost the bulls, because again, the math of it all tells you the story that you need to know. Now, the behavioral side of the story is fantastic to observe. Now, what I'm going to try to show you here is the net length of it all. Net length being CFTC futures and options contracts show us who is long and who is short of gold. Now, again, what you can see in the red box, in a gold bear market, which was what? A rising interest rate, pro-growth, strong dollar environment, the red box showed a net short position in gold. That's what people had. They were net short gold. They should have been. It was a winning position. After that, you could see basically post Bernanke, gold loves Bernanke. What you could see is that the net long position would get longer and longer and longer, the longer that people fundamentally believed that Ben Bernanke would devalue the dollar and cut interest rates, never mind to zero, redefine zero, QE minus 1, 2, 3, 4. That gave you the biggest net long position ever. And by the way, by our mathematical calculation, ever is a long time. Ever. The biggest long position ever was in August of 2011. You can see that at the top of this black line. That was the biggest speculative net long position in gold. That's what signaled you should get out. And of course, gold peaked shortly thereafter at $1,900 on September the 5th. Where we are today is in a fairly benign position, we would say, from a net positioning perspective. So a lot more safety in buying gold down here than, God forbid, if you bought it at 1900. I know a couple people on TV told you to do that. Gold. Now levels. The next 2 charts, gold, the chart. So what I'd like to show you first, to get an idea to work, first of all, the price has to start to convert. So what we would like to see here is a breakout above what we call our immediate term trade line. So that's the first line of resistance that we need to overcome. That's 1320. So I can't get like really bullish on gold. In other words, I can't do anything other than day trade the darn thing unless it goes about 1320. That's my first line of resistance. We'll see if we can do that. Don't forget that going back to the June low, which you could see in this little pink dot, was the closing low of $1,200.67 was established on June the 27th. So what we have to do before we break out above the trade line is what we have to establish is a series of higher lows. So anything above 1,200 is effectively a higher low. So that's constructive, but it's early. So again, being really early is called being wrong. So you want to be monitoring this day to day, which of course you can do watching us on Twitter. The final point is the finishing move. This is the 10-year bond yield on our intermediate term trend line. So to get gold going, never mind above 1320, can you get it to 1,400, 1,500 and higher? I'd argue, and we will argue, that what do you have to do? You have to break down interest rates. How do you break down interest rates? Well, the Fed doesn't taper in December, and then the Fed doesn't have the political spine to taper ever. That's the bull case in gold, after all. Interest rates going back below our trend line of support on the 10-year bond yield, which is 2.64%. So that would get the gold party started. Currently, you don't have a gold party. You have a bunch of bulls who are just upset about it all. And that's what happens when you have a 12-year bull market that is based on the context that we provided and the math that we're providing within this kind of behavioral framework that you have to consider within the space of time and price. So that's how we roll. That's how we're trying to figure it out. Hopefully, if you're asking us the right questions, we're going to help figure this out a little bit better and a little bit faster alongside you. If you have any questions on it, please ping us. I'm at Keith McCullough. That's my Twitter handle. If you have any questions, compliments, or concerns, please tweet me.